Good morning, hello and welcome to Money Control's live stream. You're tuned into a fresh new edition of Opening Bell with me, Lovisha Darad. We are in the midweek of the trading session and three major factors that will drive the markets from here on. First, after yesterday's expiry-related swings, which brought the markets down, today also we'll be watching out whether or not the broader markets fare, given that yesterday we did see a smart rebound, which came in from both the small caps and mid caps, which aided any, and which capped any downside on the Nifty as well. Second, the much-awaited US Federal Reserve's December meeting will be watched out. Now, this will be the last policy decision of this year, and seems like 25 basis point rate cut is a done deal, but traders have been anticipating lower rate cuts next year. So the language projections for next year is something that the market participants will be keenly watching out for. And finally, the US delegation led by Deputy Trade Representative Rick Switzer has arrived in India, and we will be holding meetings today and tomorrow. So while no formal announcement on the trade deal front is expected, but reports have suggested that the progress between the two countries in terms of the trade deal is something that they will be keeping an eye out for. So yes, after yesterday, Nifty extended losses for the second straight day. We'll be watching out if there's any reprieve in today's trading session. Global markets remain quite mixed. Yesterday, we did see US markets ended mixed overnight. On the other hand, Asia-Pacific markets today started on a largely lower note. But yes, yesterday we did see two individual stocks, Keynes Technology and Interglobe Aviation, seeing some bit of relief after news-based events dented these counters. So something to watch out for whether or not their recovery is going to be sustained in today's trading session as well. Also, new stocks in focus, Swiggy launching its QIP, Tata Power commissioning a new project. So all of these stocks will be in focus in today's trading session as well. So yes, we'll be watching out and we'll be discussing all of this with our guests in a bit. We'll also be taking your stock related queries, so keep dropping them on our live feed and we'll take them up in a bit. Now, before moving further, let's go take a quick look at the top headlines. Stocks on Wall Street closed mixed ahead of the Fed final interest rate decision of the year. The Dow sheds 180 points while the S&P 500 and Nasdaq end flat. Asia-Pacific markets are largely lower as investors await the Federal Reserve's interest rate decision and the inflation data from China that has just come in. Meanwhile, the GIFT Nifty is indicating a lower start for our own markets. Crude oil prices edged lower with investors keeping a close eye on peace talks to end Russia war in Ukraine and concerns about ample supply. Gold prices meanwhile rise ahead of Fed's decision while silver hits a record high. The DGCA has issued a fresh directive for Indigo. The new order directs airline to curtail flights by 10% on high-frequency, high-demand flights and to avoid single-flight operations on a sector. Airline CEO says operations are stable and the airline is slowly back on the feet. And India-US trade talks will be taking place today and tomorrow in all the trade-related issues. The US delegation, led by Deputy US Ambassador for Trade Rick Switzer, is expected to discuss tariffs even when talks will not be the official round of negotiations. All right, in yesterday's trading session, we did see that the Nifty has slipped for the second consecutive day, but did see a smart rebound from its lows. It recovered nearly 200 points from the day's low before a mild-late pullback. After 2 o'clock, we did see a little bit of a bout of selling pressure, but still off its day's low in yesterday's trading session. But yes, keeping that in mind, Nifty did hold above that 25,800 levels, despite slipping below that in yesterday's trading session. And broader end of the markets that continued to remain weak despite all of that. But yes, among the sectoral indices, Consumer Durable Index, that was one of the top sectoral performers, snapping its 6-day losing streak. PSU banks and realty stocks also ended higher. On the other hand, auto and pharma and healthcare, all of these indices did see a little bit of sulk in the trade, and of course they were one of the top sectoral underperformers as well. Even Nifty IT index yesterday saw a bit of a profit booking, given that large caps, for instance, your TCS, Infosys, all of them declined nearly 1% each. But yes, smart rebound that came in from the broader end of the markets. Both of them, Nifty Midcap and Small Cap, outperformed the benchmark index. Nifty Midcap index rebounded 2% from lows. Small Cap index snapped about the 5-day losing streak in yesterday's trading session and about nearly 300 to 400 points recovery also the small cap index saw from yesterday's low. But yes, all eyes will be on the China CPI inflation print that has come in, and of course the Fed decision, which is due later tonight itself, where 25 basis point is definitely a done deal, like I was talking about earlier. But the economic projections of how the rate cut scenario is going to pan out for next year is something that we'll be watching out for. Now, where do the cash flows position pan out? FIIs, they stood as net sellers, sold stocks which was worth about nearly 3,000 crore rupees in the cash markets. And DIIs, once again, they were the buyers, bought stocks which was worth about 5,300 crore rupees in the cash markets. If you look at the Nifty put call ratio, that has jumped to about 0.86 from 0.64 in the previous session, and the stock that continues to be part of the F&O ban, that is your Bandhan Bank and Sammaan Capital, the stock that has got removed, that's your Keynes Technology. After this particular stock did see, it was well received in the cash equity markets, saw about 14% gains, so to say, in yesterday's trading session. But yes, we'll be watching out whether or not Keynes Technology also sees a sustained recovery in today's trading session. But let's take a quick check of how the pre-open rates are looking like as of now. If you look at Sensex, that is still down by about 58 points. Nifty also, however, it's up by about 24 points as of now. So, it's a very mild and muted set that could be expected today, given that the global markets have also remained quite muted ahead of the FOMC outcome, which is due later tonight. But to understand how the trade setup looks like, let's quickly get on board with the technical expert of the show. Joining me is Ajit Mishra of Religare Broking. Ajit, good morning. Yesterday, we did see Nifty extending loss for the second day. But yes, of course, on the back of the expiry day volatility, but the market breadth, that turned in favor. 2:1 advanced decline ratio. And what can we watch out next? We have the Fed outcome, which is due tonight. But on the levels front, what are you watching out for?
Yeah, good morning, Lovisha. So, Lovisha, it seems like a roller coaster ride. Means on Friday, post the RBI event, we ended on a very strong note. But Monday, it turned out to be a complete reversal. Means we not only reversed the Friday's gains, but also slipped below the crucial support of the short-term moving averages of 20 EMA, which is the first line of defense, and also penetrated the declining trend line of a rising channel. Yesterday, we saw the extension of the same, though, after the initial decline, we saw that index broader markets recovered. But post this decline, Lovisha, I believe that the consolidation that we were seeing earlier means after every up move, markets spend some time in a range. So earlier it was anticipated that we were trading closer to the record highs and it might be more of time-wise correction. But it turned out to be otherwise, and now we are seeing that it's more of price-wise also. Means we are again drifting towards the key support area of 25, 650, 700 zone. So yesterday we have tested that mark and witnessed a rebound. The good part is banking is still holding strong. So private banking majors like HDFC, Kotak, Axis, they are maintaining this strong ground. Plus, though we are seeing a bit of a profit taking in IT majors, but it seems like that this time around, this move is not going to fizzle out completely. The challenging part, Lovisha, is more of broader market underperformance. Though yesterday we saw a very swift rebound, but if you see, the kind of pressure that we are seeing in, especially in small cap space, it's the benchmark index is actually not reflecting the true picture of what's going on, on the broader front. So as of now, I believe that consolidation is more likely in the index, and on the stock specific front, one should be slightly more cautious because the EMS names like you were mentioning about Keynes, Dixon, which are now seeing bit of a recovery or rebound. Stock like Indigo, which was in news for negative reason. So these kind of move wherein these very stable or strong fundamentally expected counters witness such kind of carnage, then it becomes difficult for market to maintain the sanity. And this is what we are seeing in the broader market as of now. So the focus should be more on index heavyweights, large cap names, and stocks which are holding comparatively stronger in a current market scenario. So as of now, it's in wait and watch. When it comes to the index, it should be more of consolidation buys with 25,650 positionally being the key support area. On the higher side, 26,100 to 200 will be the strong resistance zone. Meanwhile, sticks to the selective counters, avoid aggressive positioning, and wait for market to stabilize a bit.
Okay, all right. Avoid aggressive positioning in this market. But yes, let's talk about Nifty IT index. It was one of the top sectoral underperformers yesterday. But of course, the IT stocks have seen quite a bit of attraction so far this month. Once again, Ajit, what can we watch out next? I mean, yesterday it was some temporary weakness, or can we see a sustained recovery ahead?
Yes, so Lovisha, it's been almost a year now that we were seeing this kind of underperformance from the IT pack, and off late we have started seeing decent traction. Means last week IT index was among the top performing sector, on the sectoral front, and we expect this marginal profit taking consolidation to continue every now and then. The good part is that the Nifty IT index still have room on higher side, means closer to around 39,500 zone is what we are eyeing. It's currently quoting at 38,130 area. And we have multiple supports around 3,700, 37,500, 36,750 zone. So one should continue with buy on this approach. But yeah, be selective. Stock like HCL Tech, Persistent, Coforge. And then we have stock like Tech Mahindra. So these are some of the names which are outperforming within the sector. So that should be the focus point during this correction or consolidation.
Okay, all right. Ajit, let's shift focus and talk about the consumer durables index, because that did well yesterday. It snapped its 6-day losing streak. But from this basket, anything that you're finding attractive at the current levels?
See, Titan definitely, in the consumer basket is where we are seeing stability. Then other names, we are still seeing very mixed trend. It's more of consolidations, just a respite. But otherwise, the trend is likely to remain sideways to slightly negative. So aggressive positioning, especially from that short-term, time horizon, is something that you should refer in.
Okay, okay. Any picks from this particular space, consumer durables, Ajit?
Consumer durables, see, we are seeing Havels, holding strong, means we are very closer to the strong support area. And here we are seeing that possibility of a rebound towards 1520 area with very strong base around 1400 mark. So that is one pick. Then Voltas also is trying to stabilize, but we are still not seeing very decisive action. So let's the stock surpass this 1400 mark decisively, then you can look for long positions.
Okay, all right. Havels and all of the stocks we need to watch out for. But yes, the first trade's coming on your screen, where the Nifty has opened flat, but with a positive bias, so to say. It's holding above that 25,850 levels as of now. On the other hand, if you look at Sensex is down about by 13 points. So yes, we'll wait and watch how the rates stabilize. But now it's up by about 12 points. That's what is reflecting on my screen as well. A flat to a positive bias coming in for the Sensex as well. So it's a very quiet start for the markets. Of course, we did see that the global markets have also remained quite muted, and it's waiting for a trigger by the US Federal Reserve on how they actually give out the commentary for the next year of the federal, how the rate cut scenario is going to pan out. But yes, let's take a look at the broad end of the markets, because that's a smart rebound yesterday. If you look at the Nifty Midcap Index, that is 0.1% gains coming in from the midcap basket. Small cap index also showcasing a gain of about 0.1%. So it's a mild start from the broader end of the markets. If you look at Nifty Bank Nifty has started off with about 0.1% gains. Among sectoral indices, Nifty Auto Index has been doing well, 0.4% gain coming in from there. FMCG started off quite, on a tepid note, flat with a positive bias. On the other hand, if you look at Nifty Metal with about 0.2% gain, Nifty Realty Index, started off quiet with about 0.1% gain. So, of course, all in all of the sectoral indices have been seeing, quite mild gains as of now. So it's a market, where a little bit of a consolidation and pullback is once again setting in. But yes, let's take a quick look at the top gainers on the Nifty 50. Hindalco doing well, 0.7% gain coming in from this particular counter. Trent also seeing a gain of about 0.5% itself. M&M doing well. Yesterday it was one of the top Nifty losers. Today it's seeing a gain of about 1%. Wipro once again doing well, 0.5% gains coming in from there itself. On the other hand, if you look at Grasim, that is also holding up well, nearly a percent gain coming in from Grasim at this point of time. But yes, other than that, we can see Asian Paints seeing a little bit of a recovery after yesterday's 4% fall. Ultratech Cement also seeing a gain of about 0.5%. Max Healthcare pulling up in the trade, 0.4% gain coming in there. Adani Ports once again doing well in today's trading session, nearly 0.4% gain coming in for Adani Ports as well. Let's take a quick look at how the losers are looking in this market. SBI Life, one of the top Nifty losers, 0.5% cut coming in from there. Bajaj Finance with about 0.4% cut. Titans, a little bit of a reversal from yesterday's top Nifty gainers. ONGC, L&T and Cipla, some of the other losers on the Nifty 50. But yes, broader markets, they still continue to remain resilient today. Midcap and small cap index, both of them have been showcasing a gain of about 0.1%. But small cap index, if you look at that, it's turned again flat with a negative bias as of now. Ajit, I'll come to you. I mean, small caps yesterday saw a turnaround after 6 straight days. Right now, it started off flat, but can we see a sustained recovery ahead from this particular index?
So that's the major concern, Lovisha, because we were seeing when the markets were trading at the record highs, the small cap index was drifting gradually lower towards 52-week low. And yesterday, after testing the crucial support of 100 weeks of exponential moving average, we saw this rebound in the index. So yes, rebound is likely, but how many stocks are going to participate in this rebound is the key question. Means it's a very selective participation that we are seeing within the small cap space. And 17,800, 18,000 zone is a very strong hurdle. So we are just 800 points away from that area. Prior to that, also we have multiple resistance to watch out for. So as of now, refrain from any aggressive positioning in the small cap space. Those who are stuck at the higher levels, utilize this recovery to reduce your overexposure or avoid adding to your loss-making position, especially in the small cap.
Okay, all right. That's the view coming in for Nifty small cap. Let's take one stock in focus, that is your Tata Power. The stock is doing well today, given that the company has announced that it will be commissioning 400 kilowatt of Koteshwar Rishikesh transmission line, and the new line will be channeling clean and renewable energy to the states of Uttarakhand, Haryana, Punjab, UP, Himachal Pradesh and Rajasthan itself. Today the stock is showcasing a gain of about 0.5%. Ajit, how does the stock look like, however? I mean, it's consolidating around that 400 odd levels.
That's true. In fact, it's been almost 8 months now that we are seeing this range, continuing roughly around 370 on the lower side, 420 on the higher side. So after retesting the lower band, we are seeing an attempt of a rebound. 385, 390 is the zone basically where it might face the first resistance and then gradually towards the upper band. So as of now, definitely you can stay put with 370 as a stop loss, with 390 as a first target, and then around 410.
Okay, all right. 390 could be the next target for Tata Power that we need to watch out for. All right, let's take some of the viewer queries that is dropping on our live feed. The first query coming in from Shweta Naidu. She's saying that she's been holding Mazagon Dock at about 2700 odd levels, and she's asking whether or not she should shift to Bharat Electronics at the current price. 27, of course, the stock has, slipped below her buying price where it is about at 2490. Ajit, what would you suggest? Time to quit and move to Bharat Electronics?
See, no doubt that Bharat Electronics has outperformed within the defense basket big time, and but as of now, we are seeing all these stocks within the defense basket witnessing pressure, including Bharat Electronics. Majgaon is comparatively better, means the downside seems capped, from the current area. Though we are, still trading below all the major averages, but on the weekly charts, level close to around 2250, 2260 is a zone basically where we have multiple supports. BEL, on the other hand, may witness further decline, let's say towards this level of around 360. So the downside in percentage term is much higher in BEL. So not at the current levels, and also if the time horizon, let's say for 1 year or two, then you can consider switching to the position. Short term looks, BL looks comparatively weaker.
Okay, all right. BL looks comparatively weaker on a short term basis. All right, let's take another viewer query. We have Naveen, who's been asking the view on Keynes Technology and if any fresh entry level is advisable at the current price point. Ajit, what's your view? I mean, yesterday we did see a sharp run up, 14% gains, but today once again the stock is staying a bit, taking a knock off, about daily a percent decline coming in from there. What's your view? And of course, any fresh entry levels would you advise Naveen at this point of time?
Lavisha, we usually recommend to avoid stocks which are in news for any reason, means positive, negative, because the volatility is very difficult to handle. Because at that point of time, there's hardly any support or resistance that works for the stock. Though on the weekly charts, the support close around 3750 was played out well for Keynes, from where we are seeing this rebound, and possibly this rebound may extend towards, let's say, 4800 to 5000 levels also. But seeing the volatility, it's very difficult to maintain stop losses in such kind of counters. So while the index or stocks is offering much better stability and consistency in the trend with a better risk reward ratio, I would suggest stocks which are in news, be it Keynes, Indigo, let them stabilize, let them form some base, and then with a better risk reward, something that you should consider. So as of now, it's an avoid.
Okay, it's an avoid for Keynes Technology at the current levels then. All right, let's move on and take another viewer query. We have Shweta Naidu who's been asking the view on PFC and RVNL because she's seeing a loss of about 15% in both of these counters, and she's asking which is good to hold or should she book losses in both of these counters. Of course, both of these PFC and RVNL are at nearly this year's low price point itself. Ajit, what would you advise? Both of them are stark underperformers this year, and she's seeing about 15% loss.
So yes, in fact, see, Lavisha, the problem is that when the market mood is on a bad side, you usually see this kind of move unfolding even in the good counters like PFC. So first of all, a disclosure that we have a recommendation on the long-term basis to our clients for investment in PFC and REC. But having said that, the kind of underperformance that we are seeing from the energy basket or the power financiers, we believe that it's temporary. And considering the long-term outlook, one can definitely stay put, at least in the PFC. RVNL, like other railway counters, we are seeing gradual drift, but it's holding comparatively better. So in case if her time horizon is, let's say, for 6 months to a year, she can definitely stay put. Uh, Short term, definitely, in case if it is less than that, she can consider at least exiting partial position at current levels and utilize further dips to re-enter.
Okay, all right. Further dips can re-enter for RVNL stock. All right, let's take one stock in focus. That is your Adani Green. We've seen a block deal happening on the counter, and on the back of that, we've seen that Adani Green has been doing well. Nearly 1.5% gains coming in for there. Around 2 crore shares of about 1.4% equity, worth about 2,000 crore rupees, have changed hands at a price point of about 970 rupees per share. But yes, Ajit, coming to you, Adani Green, that has also been consolidating around that 1,000 to 150, 1,050 odd levels. What would you suggest? Where does the near term go for Adani Green?
So it's a very volatile counter within the Adani group of stocks. Means though from the last few months we are seeing that this range is getting narrower, and but the stock is still struggling to hold above the key support area of the long-term averages. So one should wait for a decisive close for a week or two above 1080, 1100 mark for any fresh rebound attempt or recovery. Otherwise, the possibility of this consolidation or underperformance to continue is high. So as of now, it's an avoid. If you are stuck, the existing position, 960 should be a strict stop loss, and use recovery towards 1100, 1140 area to reduce your positions.
Okay, that's the view for Adani Green. Let's take another viewer query. We have Geetu Sandesh who's been asking the view on JSW infrastructure. Of course, in the past 1 month, we've seen that the stock has seen a decline of about 4%, and the stock has been exhibiting certain, down negative trend itself. But JSW Infra, for you, how does it look like on a technical level, Ajit?
So it's a very gradual drift, while sustaining below the first resistance area, the 20 EMA, which is placed around 272 mark. And though the major support comes around 250 to 45 mark, so which is roughly around 10% away from the current area. So avoid any fresh positioning. For existing position, any respite, we need a close above 272 mark. Then there could be an attempt of recovery towards 288, 290. So as of now, with 260 as a strict stop loss, one can continue to hold the position, but avoid averaging at current levels.
Okay, avoid averaging at the current levels for JSW Infra. Let's take another viewer query. We have Naveen who's been asking that he has been holding 1,000 internal shares at a price point of about 315 rupees per share. He's asking whether or not to hold or exit. Of course, the stock has slipped below its buying price, 291, that's where we are at. What would you suggest, Ajit? Yesterday we did see a block deal also happening on the counter.
Yes, so it's been almost 2 months now that we are seeing this gradual decline post the record highs, and now the stock is currently hovering around the critical support area, the long-term moving averages, which is placed around 288, 283 mark. So, possibility of consolidation followed by a rebound attempt is likely. So, maybe around 300, 305 is something that the stock might attempt, provided it manages to hold this area. So, with 282 as a stop loss, one can continue to wait, and around 306, 308, he should reevaluate.
Okay, all right. That's the view coming in for Eternal, something that we need to watch out for. Let's take another viewer query. We have Alex who's been asking the view on JSW Energy, whether or not it is a good buy when you look at the long-term chart. And he's asking that, given that recently Jeffrey has also added in its India model portfolio, so what does it make sense for JSW Infra going ahead? Today also the stock is seeing some good buying interest, 3% gains coming in for the counter. Ajit, on a technical perspective, what does the near term indicate for JSW Energy?
Yeah, so it's a very critical area for JSW Energy because we are quoting around the 200 days of weekly exponential moving average, and today we are seeing a rebound. Yesterday also it was a good day with volume. So yes, a rebound attempt is likely, and if the view is long term, one can start nibbling currently at existing levels with 440, 420 being the lower base. For the entire position, 400 should be the stop loss because in case if it fails to hold that area, then probably we are set for the declining phase instead of consolidation. So yes, selective buying can be done at current levels, and one can add more around 440 area.
Okay, 440 area one can add around for JSW Energy. Let's take one stock in focus, that is your Nalco. The company did approve its proposal to select Dilip Buildcon as the mine developer and operator for its vital Potangi bauxite mines itself. But yes, today the stock is not reacting well to this news. Nearly 0.2% decline coming in for this counter. But Ajit, I mean, how does the stock look like? I mean, it has been an outperformer this year and it has seen a secular bull trend.
Exactly. So, in the metal space, some of these stocks like National Aluminum, VEDL, Hind Copper, they are holding, strongly amid this, correction and consolidation. 258, that's the critical support, the 20 days of exponential moving average base. In case if it manages to hold this area, we are set for the newer highs in days to come. So as of now, 276, 278 should be the target zone with 258 as a stop loss, and one can continue to stay put.
Okay, all right. That's the view coming in for Nalco. Let's move on and take another viewer query. We have Shweta who's been asking the view on M&M because she's bought the stock at about 2,700 and she's asking whether she should book profits or add more. Given the current price of M&M is about 3,600 rupees per share, Ajit, I mean, she's seeing nearly 30% profits at the current price point. So what would you suggest? Should she book profits or add more at the current price level?
Yeah, so in case if her time horizon is long term, means over a year and more than that, then definitely she can consider adding more even at current levels because after this prolonged consolidation, around 3,400 mark, we saw the breakout and it's gradually, inching higher. So we still feel that there's more room to the, upside, maybe close to around 4,000, 4,100 is something that the stock might attempt in next 3 to 6 months. So definitely he can consider adding more with the long-term time horizon.
Okay, all right. That's the view coming in for M&M. Let's take another viewer query. We have Clash who's been asking the view on Fortis for a fresh entry at the current levels and how does the stock look like. Of course, the stock did hit a high during in the month of October, but since then the stock has seen a little bit of a slide. It's seen a slide of about 20% or so. What would you suggest? How does the near term look like, Ajit, for Fortis Healthcare?
So yes, a very strong outperformance means roughly around from 300 to 1100 with hardly any major correction. And now we are seeing some, decisive dent from the record highs of roughly around 1100 to now the long-term averages around 850, 860 mark. So possible technical rebound definitely seems prudent on chart. Maybe close to around 910, 920 is something that the stock might attempt. So with stop at let's say 840, one can look for this rebound rate. But if you are planning for any positional or long-term investment, buy partially here and wait for any dip towards, let's say, 800 zone to add more.
Okay, all right. 800 zone is something that we need to watch out for, and we can add more from that particular level. All right, let's move on and talk about another stock in focus, that is your Godrej Agrovet. The stock has been flat with a negative bias, but we did see that its unit, that is your Creamline Dairy, has said that they have signed an MOU with the government of Telangana to set up a dairy processing facility with an investment of about 150 crore rupees itself. Ajit, I mean, the stock has seen a sharp decline over the past 6 months. Today also the stock is not sulking in the trade with about nearly 0.3% cut. Can we expect further fall from the current levels?
Yes, so post this breakout failure in the month of July, the stock has retraced considerably in the last few months. But now we are very closer to the critical support zone. Means 550, 570 is a very strong base, and for almost 3-4 weeks we are seeing that stock has been consolidating around that area. So probably we may see a breakout or a recovery attempt above 620, which can help the stock to inch towards 675, 680. So from the technical point of view, one can look for long position or accumulate gradually in this range of 590 to 575 with 550 as a stop loss and 600, 625 as the positional targets.
600 and 650 as a positional target for this particular counter, the Godrej Agrovet. Let's take another viewer query. We have Mrudang, who's been asking the view on Kalyan Jewellers whether or not we can add at about 472 odd levels. Kalyan Jewellers, any particular view, any thoughts on this particular counter? Today the stock is quite flat with a positive bias.
Yes, so what we are seeing after the critical support retest of the trendline resistance or trendline support rather on the weekly chart, we are seeing this recovery. But it seems more of consolidation with a negative bias as of now, and this would only change once we reclaim the long-term averages around 520 area. So as of now, it's an avoid cause consolidation or sideways trend is more likely with strong hurdle at 590 than 510 and 520. Means every 15-20 points we have some resistance or the other, and on the downside a break below 450 can trigger next leg of the down move also. So as of now, it's an avoid for existing position. 460 should be the stop, and use any recovery towards 490 to reduce your positions.
Okay, all right. That's the view for Kalyan Jewellers. Let's take another stock in focus. That is your Swiggy. Well, the company has announced and launched its 10,000 crore rupees QIP with an indicative floor price of about set at 371 rupees per share, which is down by about 7% below its previous close. Ajit, I mean, the stock did well yesterday. Today also the stock has been holding well. But from a technical perspective, how does the near term look like?
Yeah, so it's been almost like 2 weeks now that it's been trading in this very tight range, 400, 380. Today we are seeing an attempt to break that range plus reclaim the long-term averages also. So this may result in further recovery towards, let's say, 420, 430 area. So with 395 as a strict stop, one can preempt this breakout and wait for the target of around 420 in the near future.
Okay, 420 in the near future. All right, just one last question before we let you go. What are your top picks? Let us know, and anything that you're finding interesting in the markets.
Yeah, so see, the important aspect is that volatility is here to stay is what the indications are. So stick with the quality names is something that we have been advocating to our clients also. iShare within the auto space has been holding around this record highs amid this choppiness. In fact, the entire auto basket, if you exclude few names, M&M, TVS, they all are holding strong. So auto is something that you should definitely focus. So with iShare, 71, 76 is something that's currently quoting. So with stop at 70, 60, one can look for long position at current levels with 73.50 as a positional target for iShare. At the same time, since we are seeing extreme volatility, one should refrain from aggressive positioning in sectors which were underperforming or stocks which are underperforming. But pharma, we believe, is one basket wherein we are seeing a bit of stability, or at least they are not volatile as what we are seeing in the other spaces. So Sun Pharma, after this recent decline, we believe that it's a good zone to look for long position. We are retesting the short-term support area. So with stop at 1740, one can accumulate some pharma at current levels with 1850, 1860 as a target zone.
Okay, all right. Those are the stocks we need to watch out for. But with that thought, we have to let you go, Ajay. Thank you so much for your time and joining us.
Thank you, Lovisha.
All right, let's take a quick check of the markets before I move on to our next guest of the show. If you look at Sensex, that's up by about 270 points. So some recovery which is taking place in the markets, given that we started off quite flat, but with a positive bias. Nifty also holding up well, 70 points gain coming in from there. 25,900, we have reclaimed those levels as of now. But yes, the much support is coming in from the broader end of the markets, because if you look at mid-cap and small caps, both of them showcasing a gain of about 0.4%. On the other hand, if you look at from a sectoral point of view, Nifty Auto Index has been leading with about 0.6% gain. Metals also has been doing well, nearly 0.8% gain coming in from there. Realty stocks doing well, metals, all of the sectoral indices have been, pulled up, and they are in the positive territory, so to say. If you look at the market breadth, that is well in favor of the advances versus the declines, 2:1. Advanced decline ratio at this point of time. So yes, the texture of the markets seems to be stabilizing as of now, given that India VIX has also cooled off from yesterday's levels. But yes, with that, let's quickly move on to our next guest of the show. We have Harish Krishnan, Co-CIO and Head Equity of Aditya Birla Sun Life AMC, joining us to discuss how the market sentiment looks like. Harish, good morning. I mean, we have the Fed outcome tonight, and 25 basis point rate cut. It's like a done deal. But traders are penciling in lower rate cuts for next year, given that US economy is looking like in a Goldilocks scenario. But for you, what factors are you watching out from today's meeting?
So I think the bigger aspect for Indian equities is more with respect to the trade policies that the President Trump administration has kind of levied, and how that gets resolved. Because there has been a lot of significant depreciation that the Indian rupee has seen over the course of this calendar year. And any stabilizing moves on the currency front is what we will look out for from these global policymakers as to how they think about the likely place of where the dollar can stabilize, and conversely where the rupee also can stabilize. So for me, that will be the key. The second aspect, of course, is till now we haven't seen inflation coming into US, despite these tariff uncertainties. How that is likely to kind of shape through is and the thinking behind that is what clearly is going to be the second point. And of course, the third is clearly with respect to any change in the Federal Reserve, from the governor point of view. That's the other aspect that market participants will watch out for.
Okay. Harish, it's been nearly a year, and the US-India trade deal, that overhang continues. Yesterday, we saw Trump hinting at fresh new tariffs on Indian rice, but the impact decoded so far is negligible for India. But in terms of sentiment, I mean, is this going to be a drag and a key determinant for the FIs to make a meaningful comeback?
So, see, the issue for foreign investors is not that Indian markets are significantly over expensive or there's a lot of froth. I think that could have been the argument about a year back. But with the significant amount of time correction and a reasonable amount of correction, especially going, the froth is kind of reduced quite significantly. The challenge for foreign investors is therefore more not from the equity basket but from the currency basket. So if you have an earnings growth of say low double digits and high single digits, and if you see anywhere between a 7-8 or even a 10% depreciation of the rupee against the dollar, that pretty much wipes out all the gains that you're making as from an earnings point of view is concerned. And which is why, like I said, where the rupee settles at is very important for the foreigners to get back into the equities game from an Indian perspective. And therefore, that becomes the first marker or the lead indicator in terms of assessing the sentiment of international investors coming into India. But just want to caveat it also by saying that, this is the here and now, the very short term. From a slightly more long-term perspective, we are having multiple conversations with international capital allocators. And when we converse with them, there is a greater appreciation of the Indian fundamental strength, the Indian macro setup, as well as the fact that India's share of world economic output, which is today shy of about 4%, is likely to double in the course of the next 10, 12 years. And in that context, India's share of world market cap today is close to about 3.5%. Therefore, for a really long capital allocator, this valuation provides a wonderful time frame to get into Indian equities. In short, we need stabilizing of the rupee. That becomes the first key indicator before we start to see a significant amount of flows getting back into Indian equities.
Okay. But do you believe that the worst is behind for the rupee movement, given that it's seen about 5% depreciation already this year?
We do think that if you look at the setup in 23 and 24, the Indian rupee was the stablest currency among the G10 countries. And that was predicated on a very strong fiscal prudence roadmap that in the Indian government and administration had administered post-COVID, compared to many other countries which had put in these steroidal injections, if I may, for boosting their economic growth. What the only thing that has changed this year is, of course, the US trade policies. There is the export channel which needs to be more competitive, and the response of the trade policy reset is being felt in the currency markets more than the equity markets or the fixed income markets. So that becomes the shock absorber to and the first line of defense for the RBI and the government to kind of cushion in the impact of the trade deal, not culminating yet. So our sense is that we are closer to the trade deal. Of course, it's very hard to second guess Mr. Trump. But given the fact that it's been close to about at least 6 months since the additional tariffs have been imposed on us, we do think that there is a greater chance that a resolution will be around the corner, and therefore we are a lot more optimistic of how the rupee is likely to kind of bottom out in the near term, as well as consequently we are positive on Indian equities as well.
Okay. Harish, but what does it mean for the exporters? Because they have been hardly hit by the tariffs this year. If you look at the marine stocks or even the key exporters like textile stocks, for that instance, everyone has been trying to diverge and trying to tap into newer markets so that they can reduce the concentration in US. But what do you make of this? I mean, is this going to be a slow process? And what is the kind of earnings impact are we going to see from the upcoming quarters from the exporter side? What is your assessment?
So we break the exporters basket into two buckets. One is the low margin exporters, and second is the higher margin exporters, which have a significant market share in the end markets, or have a reasonably large market share even in global markets. At this point of time, we are far more positive on the latter compared to the former, because while there is going to be a near-term earnings headwind, courtesy these the tariff imposition, as well as it's not going to be so easy to find additional markets to suddenly swing your trade by. But we do think that these are companies which have actually been an important cog in the global supply chains. Given the fact that they are operating at very high margins, north of 20%, certain cases even 30% EBITDA margins, we do think that they have enough in their profit and loss statement to cushion the near-term headwinds. Yes, while that is an earnings downgrade in the near term, we take comfort in the fact that the valuations are more driven by the terminal value of these companies and not necessarily by how the next 6 quarters or the next 8 quarters necessarily come through. And therefore, we are increasing exposure to those kind of export basket, wherein we believe that the market shares that they enjoy are very high and the margins are reasonably good. And this therefore becomes a transient shock, which will make these companies stronger. And therefore, on the other side of whenever the trade deal gets settled at, they will emerge much more stronger and far more resilient to provide value to our unit holders.
Okay. Harish, from an earnings growth front, I mean, we do have RBI's rate cut, and so far this year they've already cut interest rates by about 125 basis points. So for lenders, especially for banking majors, they were expecting that the margins could bottom out in the second quarter. But this makes a difficult path ahead. So what are you expecting from the upcoming quarters, and does that make you revise your overall earnings growth guidance from the banking majors?
Yeah, so again, this year has been a difficult year for the lenders, primarily as you rightly said out, the interest rates cuts does impact the net interest margins for most of the lenders. But they were enjoying supernormal margins going into this rate cut cycle in 23 and 24. And many of the private sector banking stocks didn't react when they were making these record profits in 23 and 24. Private sector banks actually had underperformed the broader markets at that point of time. So we do think that this reset of margins is pretty much priced in. Most investors do acknowledge that the here and now, the next 2 quarters is going to be slightly softer. But I think the setup that is likely to come through beyond that is looking far more interesting, which is that there is definitely a growth impetus, both by the government as well as by the RBI and the banking system in general, which has ceded a significant amount of market share to non-bank lenders and to the shadow lending cycle. Will now get back into the growth vector. So that's point number one. Secondly, the credit cycle still continues to remain benign, and that provides a comfort. And more importantly, about 6 or 9 months ago, there were only about 4 or 5 private sector banks which were trading above one-time book, which meant that they only had access to capital. What we've seen in the last 3 4 months has been a significant amount of capital going into smaller run private sector banks, which have all kind of got reflated. So therefore, we do think that the banking system is looking quite interesting. And we continue to maintain that from a 3 year point of view, banking sector, especially on the private sector banks, can provide reasonable outperformance to the overall broader market.
Okay. Harish, what about insurance? I mean, how are you placed there? Because we did see after the GST announcement, majority of the stocks have traded mixed. But if you look at the November data that came in yesterday, it showed a good premium growth, about in double digits itself from the entire sector on the back of the GST benefits. But going ahead, how are you positioned there?
So we are positive on insurance, primarily of the fact that 5 years back, pre-GST, given the high valuations that the industry had enjoyed and the strong outperformance, almost every large group wanted to float an insurance company, and there was significant amount of supply side disruption that was coming through. Fast forward now, what we've seen over the course of the last 5 years is that a lot of these smaller players have kind of vacated their share. And there's been a reasonable consolidation with the big five or the big 10 names gaining market share at the expense of the tail. This, to our mind, is a very useful setup to think of from how value can go back into the larger companies within the insurance franchise. They have underperformed over the course of the last 3 5 years. The tailwinds, as you rightly captured, be that of GST. While there is a near-term headwind in terms of margins getting impacted for this year, we think that from a longer-term perspective, the fact that the competition or the competitive dynamics are a lot more benign, and the fact that we continue to remain reasonably underpenetrated provides a significant opportunity for insurance names to create value over the medium term. So we continue to have a positive bias to insurance plays as well.
Okay, got it. What about the real estate sector? I mean, despite the RBI's rate cut so far this year, this sector has been largely unmoved. And if you look at majority of the realty stocks, they've seen a turbulent year. I mean, it's been a multi-year rally, 2 years of back-to-back rally that the index saw. But going ahead, how does the scenario look like? Because if you look at the second quarter results, they were fairly good on the back of the festive sales. But do you expect this momentum to sustain in the upcoming quarters?
So we've been underweight on real estate over the course of the last year or so, having been largely overweight on the space in 23 and early half of 24. And our primary thesis has been that there has been a lot of supply of paper in real estate. Post RERA, if you go back to 2017-18, there appeared very few real estate developers that had access to capital, both on the debt side as well as on the equity side. And this provided a significant setup that when demand started coming through post-COVID, these were the companies that gained significant kind of salience in terms of launches. The launch velocity went up significantly, the profit pools went up significantly, and the capital structures became a lot more better. In towards the fag end of 23 and 24, what we did see was that there were a lot of older players which had kind of got into the joint development model as they were finding it difficult to execute projects, etc. in the new regime. Suddenly started to attract capital, and with that there was a spate of QIPs and new IPOs from the real estate setup that came into the equity markets. With access of capital broadening, we felt that supply is going to intensify. So even as we continue to remain positive on the demand outlook from a slightly medium-term perspective, we're more worried about the supply outlook that's starting to change at the margin, and that is when we went underweight. We continue to maintain that stance. The demand of real estate continuing to be quite robust. We like to play that through other material companies, including cement, including paints, including building materials, and including materials, which is the commodity names, which is kind of underperformed over the course of the last 3-5 years, and which we think over the course of the next 3 years is likely to do much better. So that's been the pivot that we made in our portfolios from a slightly more medium-term point of view.
Okay, all right. Underweight on realty, but bullish on the building materials space as of now. Harish, it's been a narrow market and everyone has been hunting for value. But anything that you're finding comfortable in terms of valuations and good growth visibility? I know we discussed about banking and insurance, but apart from that?
So we think that there are opportunities, for example, in the chemical space, where there's been a significant amount of capex that has happened over the course of the last 3-5 years. There are some very nice niche companies which have global market shares. They've all got impacted by the current tariff setup, as we discussed. But we think that these are companies that will come back even more stronger. So chemicals is an area of interest. Auto ancillaries is another area, especially which are very large market share in the global setup. I think that becomes another interesting area where we are incrementally deploying more capital in. Consumer, this has been an area which we've been underweight post-COVID till about 3 or 4 months back. But we think that this entire pivot of the government and the RBI to get back into demand boost mode is likely to help consumption as a whole from a medium-term perspective, and therefore we have kind of taken exposure away from the investment theme, which had done exceedingly well post-COVID, and we are moving more and more into the consumption theme. So these are the baskets where we think that at least from a medium-term perspective, risk reward is far more suitable. In certain cases, there are catalysts in the horizon. In certain cases, catalysts might be more back-ended. But we do think that the relative margin of safety is a lot higher in this set of names rather than in the B2B industrial complex, where again things are looking good from an earnings point of view, but expectations have got built up significantly higher and returns have been front-loaded a lot, and therefore we want to go underweight that space.
Okay, got it. Plenty of sectors that we need to watch out for. But yes, with that, we have to let you go, Harish. But thank you so much for your time, and of course, interesting conversation as always.
Thank you.
All right, let's take a quick check of the markets. If you look at Sensex and Nifty, both of them are off the day's high. Sensex is, however, up by about 150 points. Nifty is also above that 25,890 levels. It has slipped below that 25,900 odd levels, but still remains in the positive territory with about nearly a 0.1% gains. If you look at the other end of the markets, the mid-cap and small caps, both of them have also trimmed some bit of gains as of now. If you look at Nifty mid-cap, that is showcasing a gain of about 0.3%. Nifty small cap also showcasing a gain of about 0.4% as of now. So yes, both of them have been remained resilient in this market. On the other hand, if you look at Bank Nifty index, 0.2% gain coming in there. All of the sectoral indices have been trading in the positive territory. Good buying traction coming in metals, in the metal space. IT stocks doing well, realty stocks holding up quite well. Consumer durables once again extending the gains to the second consecutive day. But yes, let's watch out, how the second half of the session pans out, because it's been a positive day for the market so far. Whether or not we can pick pace from here, whether or not the recovery can sustain in the second half of the trading session is something that we need to watch out for. But for now, we have come to an end of this edition of Opening Bell. Don't forget to tune in at 3 o'clock for closing, and we will be discussing how the market has developed with our experts, and we'll also be discussing the stocks that have grabbed the headline. Until then, signing off, do stay tuned to moneycontrol.com.